This is the Progressive Dentist Podcast, where we help dentists like you improve your practice and teach you how to keep more of what you make. Here's your host, Craig Cody.
Hello, it's Craig Cody here with the Progressive Dentist Podcast. Today we're going to speak about proactive tax planning, keeping more of what you make, and a couple of more of what I call the biggest mistakes that I see dental practice owners making. The first one we're going to talk about relates really to the new tax law that's about a year and a half old, signed in December of 2017, went into effect January 1st of 2019. It regards qualified business income, also known as Section 199. And this is a deduction that the government is giving business owners, small business owners, namely S corporations, LLCs, sole proprietorships, and partnerships, a deduction for up to 20% of the net income of the business. So that means if you have a dental practice and your net income is $200,000 after expenses, you can get up to a $40,000 additional tax deduction. So let's just say you're in the 24% bracket. That's about a $10,000 savings on federal income. So it's something that we want to plan for. And you know, I'm a big proponent of planning, communicating with your CPA, and taking the time to make sure you're able to maximize these types of deductions. Section 199 is broken up into two different distinct groups: qualified business income and specified service business income. And dentists, doctors, attorneys, CPAs, and other professionals, as well as certain types of consultants, stockbrokers, are considered specified service businesses. And what that means is that this 20% deduction, if your taxable income, not your adjusted gross income, but your taxable income, falls somewhere between $315,000 and $415,000 for a married couple. If your taxable income is in this range, it starts to phase out. So what that means is at $315,000 of taxable income, you will get the full 20% deduction. As you approach $415,000, you get no deduction. So this is a real planning opportunity to see what you can do if you're in that, what I call that bubble, 315 to 415 or just over 415, to get some additional deductions, do some planning, and get the benefit that goes along with Section 199. So what can we do? We can look at retirement planning. We can look at, have we hired our kids? Maybe hired a spouse, and if your spouse is working with you and you do a 401k and you max out the 401k, that could be another $18,000, $19,000 of deductions. So these are things you can do, but they all come down to taking the time, speaking with your CPA, and looking for ways to legally minimize the tax. So that can be such as maybe you need to purchase some equipment and you've been putting it off. Maybe you're going to wait until January. Maybe November, December is a good time to purchase that equipment, because you could do what we call Section 179, is write off the full amount of that equipment, and that's going to then reduce the amount of your income that year. So 20% on $200,000, $40,000. If you're at $315,000, that's about $62,000. And like I said, even if I just say 24%, that's $15,000 in savings. So it makes sense to do some planning. Up until this year, a lot of people were in the dark. Some people are still in the dark as it relates to Section 199. And Section 199 came about because the government is giving C corporations a lower, flat 21% tax rate. So they wanted to do something for what I call Main Street, which is people out there like us, small businesses, hiring people, supporting communities. So they said they should get the benefit of these, tax breaks that big corporations are getting. So they came up with Section 199. Not really sure why they decided to carve out professionals, attorneys, dentists, medical doctors, CPAs, consultants. But they decided to do that. So if you fall into what we call a specified service business, it's important that you take some time, speak with your CPA, and making sure that you're doing everything you can to legally reduce your tax liability. And if you're able to get down to that $315,000 number, if you're there, you could save some nice money, and rather keep that money, do something with it, whether it's expand your business, put it into retirement, or do something like that, then give it to the government when the government's actually giving you a legal way to keep more of what you make. So that's Section 199. On the same note, we talked about Section 179, which is when you purchase an asset and you get to write it off all in the same year. We also have what we call bonus depreciation, which is nice, but sometimes it's not as good as Section 179, because depending on what state you live in, if you have a state tax, a lot of states do what we call decouple from the federal way of doing taxes when it comes to bonus depreciation. So you might get the bonus depreciation on your federal return, but that $50,000 or $100,000 piece of equipment gets added back for your state return. Whereas when you take Section 179, that's not typically the case. So that's another conversation you want to have with your CPA and make sure that we're not just taking bonus when we may be able to take Section 179 and depreciate the whole property in the year we purchase it. Another big mistake we see is amortization. So amortization comes in typically with when you purchase a practice, there's something called goodwill that goes on your book. So goodwill is typically the difference between what you pay for a practice and the fair market value on the date you purchase the practice of the assets you're buying. So if you buy $1 million practice and the fair market value of the assets that you're purchasing are $400,000, that means you have $600,000 worth of goodwill. That $600,000 worth of goodwill gets amortized, written off, or expensed over 15 years. So if my numbers are correct, that's about $40,000 a year of amortization, which is a non-cash expense. It's something that a little bit too frequently I see as people are not amortizing goodwill. What's happening is they're making a purchase, they're buying a practice, they're not really working on a regular basis with a CPA. They go see somebody to prepare their taxes. It's March or April. It's really late. The CPA kind of has his head down because he's just trying to get everything out the door at this point, and no amortization is taken. So once again, if you're in the 20%, 24% bracket, amortization on a $1 million practice might be costing you $10,000 a year in taxes. That's money you could be putting in the bank, putting into advertising your business, all sorts of things. So it's also going to help you along with Section 199, because if you do it correctly, you're going to lower your income and hopefully enable you to still take the Section 199 deduction. The final thing I want to talk about today is hiring your kids, okay? Now, I'm a big proponent of putting your kids to work. Mine all worked for me while they were in school. The government says that you can hire, and this is actually tax court, Supreme Court, ruled that you can hire your kids as young as 7 years old, all right? I typically like to wait till kids are around 11 years old till we start putting them on the payroll. But then you can pay them a reasonable wage, and it has to be reasonable for what they're doing. So, if little Johnny is licking stamps, you can't be paying him $1,000 a month. But you could pay him a reasonable wage and put that money into a Roth IRA. And then when Johnny's ready for school, he's got all this money put away, or down the road for retirement, way, way down the road. There's extra money there. Another thing is you can pay, let's just say you have an older child. They can make up to $12,000 a year before they pay any federal income taxes. Now, their wages are still subject to FICA tax, which is about 15.3%. But if you're in a high tax bracket, the spread there makes sense to do it. It's also going to lower your taxable income. So if you have a couple of little Johnnies, you could reduce your income by, $36,000. Now, they'll pay it a little smaller bracket, they'll lower rate. You may qualify for Section 199. Another way you can hire your kids is, let's just say you have a rental property, and your rental property might be a Schedule E or a Schedule C. depending on how you have it set up. If it's a single member. Filing form Schedule E could be doing something where you have a Schedule C, or you may have another business where you have some other income coming in and you file a Schedule C. Maybe you do some consulting work. If you pay your child through this Schedule C, they're not subject to FICA taxes. Now, they still get a W-2. You still have to fill out all the correct forms. But up until they pass their 18th birthday, you don't have to pay FICA tax. So then when you're in the 33%, 34%, 35% bracket, whatever we want to call it, you're really saving a lot. The spread gets a lot bigger there. So $12,000 in that bracket, let's just say that's saving you about $4,000. And if you have a couple of kids, you multiply that out, it turns into a lot of money. So everything we've talked about today comes down to planning, communicating with your CPA, and really taking the time to do the things that you would do if you were going to take a trip, buy a car. People buy a car, they spend a lot of time planning. They go on a trip, they spend some planning. A lot of times we're wrapped up in our businesses. We don't take the time to spend planning on legal ways to reduce our tax liability. So the bottom line of the SoloCast is you should all be speaking on a regular basis with your CPA and looking for legal ways to reduce your income. And that might be Section 199. That might be through hiring your kids. That could be amortization of goodwill. It could be buying equipment that you need, only buy stuff that you need, and writing it off. So those are things, if you're not doing it now, get on the phone, speak with your CPA, and figure out how you could keep more of what you make. Until next time, Craig Cody, have a great day. Bye-bye.
Thank you for tuning into this episode of the Progressive Dentist Podcast. We would greatly appreciate it if you left us a rating and review of the podcast so we can continue to help you and other dentists. Be sure to go to theprogressivedentist.com to learn more and make sure that you keep more of what you make.